Callie, you say you're relying on the data right now to navigate the market. What data specifically are you watching?
Well, simply job market data, Brad. And it's really hard to simplify what an analyst looks at right now. But if you want a read on the economy, you have to look at the consumer. And when Americans are making money, they're spending money. So I'm watching initial jobless claims. I'm watching warn notices to see if layoffs are increasing. Because where we're at in the job market is that companies are hiring less. If you're looking for a job, you could probably confirm that. But at the same time, they're not really firing people. We're in a bit of a frozen state right now.
And so it's so interesting because on one side, on the public sector side, you have this mindset of efficiency that's certainly rattling through and prompted by the Department of Government Efficiency. And then on the private sector side, you have the mindset of, okay, well, we'll just wait for attrition to happen. And if that doesn't happen, as is the case with Morgan Stanley most recently, then that's when they will use to, or as a reason code at least, to announce or look across some of where they need to trim. And so how are you going to be watching the data to see where those two things show up and if there is a trend that eventually gets made?
Well, let's split it how you just did, Brad. So the public sector obviously going through a lot right now. I'm guessing hiring in the federal government is effectively frozen. There's probably heightened attrition, and we are reading about layoffs there. I think people forget this, but the government sector is a huge part of the job market. The federal government employs about 3 million people. And we're still not sure about the size of these layoffs, although we're getting some indications right now that they could be large. So what you're getting from the public side is less hiring, which is critical because government was one of the only sectors that hired throughout the past year. You're also getting attrition and the chance that they're not filling those payrolls, and you're potentially getting these layoffs that we're still trying to figure out the size on. On the private side, I think corporate America is in a good spot right now, especially bigger companies that are more profitable can be self-funding. So the fact that you're not seeing many layoffs on the private side is probably because companies feel okay, but that doesn't mean they'll be okay in the months ahead. And there's a lot of uncertainty.
And so amid that uncertainty, what is the trade thesis that investors would be apt to keep in mind, even as they're looking across some of the pullbacks that we've seen in recent weeks?
Well, I'm assuming I'm talking to a lot of long-term investors because this is a program about wealth. So I just want to remind people that you do have a lot of agency here with your portfolio. I mean, chances are you have years and decades ahead of you to build that wealth for retirement, for that nest egg that you're looking to build. So, if we see pullbacks here, especially if they're not accompanied by a breakdown in job market data, it's probably a good sign to put some money to work. We've seen corrections or 10% sell-offs in the S&P about once every couple of years over the past 7 decades. And if you remember that and are armed with the right context heading into a sell-off, you can feel confident investing more money in the market. Just stay defensive and stay on guard for risks.
And so what are some of the early indicators that investors who perhaps have some FOMO about missing out on the next rally or missing out on a dip buying opportunity, what are some of the indicators that they should be keeping tabs on to know that there is a more concerted or more conviction-led trade that the rest of the market is starting to rally around?
Well, I sound like a broken record, but again, job market data, economic data, signs that the economy is breaking down are probably signs that the stock market could head lower. Of course, nothing is a clear-cut rule of thumb in finance, but generally that's what we've seen over history. And again, I would look at job market data. I would listen to what companies are saying. And right now, even though corporate profits are growing at a pretty decent rate, we are hearing companies pull back on their optimism for the future. And we are seeing CEO confidence gauges fall as well. So the way that I would take that is, I wouldn't be too cavalier in this environment. It's a delicate dance at the moment. I would look towards those more defensive sectors in the market and just understand, what your time frame is and what you're invested in and how you can strive for that portfolio balance.
Callie, thanks so much for taking the time here with me today. Appreciate it.
Thanks for having me.